Do you want to know the 5 money accounts that you need? Do you wish your money would move automatically into the different separate accounts? Do you wish you never had to worry or stress about money again? This is what we're going to talk about today in this video for Millennial Money Mindset. Thanks so much for joining us. My name's Neil Doig. I'm the founder of Money Tips. We aim to put money in your pocket, more time in your day, and more happiness in your life. If that sounds interesting, stay right to the end because we're going to give away loads of value in this episode. We're going to give the 5 money accounts that you need. This is all you need for your investing. So we want to make everything simpler, easier, and more achievable. So this episode came about because I was chatting to a guy in a pub and on last Friday actually, and he was saying how he just didn't know where his money went and he would spend loads of time stressing and worry about his money and his investment, and he didn't know where everything was. And I was just thinking back to when I worked for Shell trading for Shell for over a decade, and I came up with this system when I was working for that company to automate everything. And as technology has improved, it's made everything even easier. This is great news for you. And you can do everything at a click of a button. And we're going to go through this step by step. So this is a real basic episode, and we're going to try and give away as much value as you can. If you put this into practice, this is going to save you so much time. And if you use the investment platforms that I have, that I use, there's some really good ones out there, some really terrible ones out there. This can save you tens of thousands of pounds over your investing lifetime for basically the same product. So this is going to be, hopefully it's going to be really impactful for your investing and your money management. So there's basically 5 accounts that you can use, all you need. So I see one of the big mistakes I see people making is overcomplicating everything. So the first account is basically your bank account. So when you work, your money, you'll get paid and your money will go into that account. And so we're going to start real basic and we're going to build it up from that. So you have a job and your employer pays that money into account. So that I think that the bank account that you use doesn't necessarily matter. So just pick a high street bank. Today, there's been an increase in interest rates. So because the interest rates has increased, this means that you want to get more money back from your savings, which is great news. So you can pick a high interest savings account. And also there's money to banks basically are desperate for your business. So there's huge amounts of money to be made by switching your accounts. I used to do this a decade ago when interest rates were high and interest rates were low for over a decade to try and combat, basically they want to increase lending and borrowing. So the Bank of England reduced interest rates, but now over a decade later, because inflation's rose, interest rates have risen again. And we've talked about this in other videos, but basically it's good news for you as a saver. So so the number one, to keep things simple, is you just need a bank account. So first of all, most people have a bank account. Keep that pretty simple. So number 2 is, the good news is it's all automated. So number 2 is pensions. So there was some legislation that came out in 2015 called auto enrollment, which basically means that your employer by law has to auto enroll you into a pension account. So this number 2 is the simplest of all of them, because basically your employer will do this for you. So if you're working at a job over a certain threshold, basically a full-time employer, your employer by law has to put money into a pension account, which is great news for you. And there's also other things you can do. So some employers basically will match what you put in. So check what you're putting in, check what your employer's putting in. And the third great thing of a pension is there's tax relief, which basically means you get free money, which is great. We've talked about this in other videos, but it's super important to highlight this again. So you're getting free money. So just go speak to your employer, go to your HR department and ask about your pension. There'll be some sort of paperwork that you might have been sent, but it's good to do this again, and you're basically getting free money. So 1, you're contributing, you're auto-enrolled. 2, your employer might also match what you put in, which is basically free money. So the more you put in, the more your employer will put in. And then 3, your tax relief. So you'll get tax incentives due to the government encouraging you to invest. So this will be there's basically like a number of different ways that they can do this, but basically you get taxed, your income tax, basically 20%, 40%, or 45%. And you'll get this back by contributing to a pension. So if you're a basic rate taxpayer, you're getting 20%, you'll get that back. If you're a higher rate taxpayer and you're paying 40% income tax, you'll get that back. If you're an additional rate taxpayer, you'll get 45% back. There's a few different caveats when you're an additional income taxpayer, but you're basically getting back 40%. So into your pension. There are other caveats that you can't take that money out until you reach your retirement age, which is currently 55, and it'll be 57 when millennials retire. But this is free money, so this is brilliant. And also another thing, the last thing to point out, if you've got a number of different employers over the years, which many people today, especially millennials, will be essentially, you might have left a number of different, you have worked at different places. You can now combine these pension pots into one simple pot, and that might save you money on fees. It might mean that your asset allocation will be better compared to if you have a number of different pots. The asset allocation might be basically conflicting each other. You might be playing it real safe, or you might be playing too much risk. So by putting it into one pot, this will basically simplify everything. If you want to know some of these platforms, I give basically a menu of platforms in my members area. So we have a members area in moneytips.org. And we give away so much value in this members area. So if you want this platform, this menu of platforms, a pension platform, just put a note in the comment and say, yes, I want this menu of investment platforms, and I will send that over. Usually this is only I only give this away for our members, but today I'm feeling generous and I'm going to give away this. If you're watching this video and you want this, it's basically a number of different platforms. I also use a matrix between cost and complexity, basically different platforms versus the cost, how much it's going to cost, and how complex these platforms are. And you basically pick which of a platform which is right for you. Today, it's brilliant. There's never been so many choices. It's never been simpler, and it's never been cheaper to invest. This is good times if you're watching this and saying, yes, I want to invest. So put a note in the comments and I will send that over. So that's number 2. That's pension. So number 2 of the 5 accounts that you need. So that's pension. So you've got your bank account, then you've got your pension accounts. And one more thing, another thing about pensions actually is the state, so the government will also give you a state pension, which you will collect when you're at 67. But what you need to do to be allowed to have this state pension, you need to contribute your national insurances for 35 years. So you need to be paying in for 35 years. And if you're not sure if you're paying in, if you're not sure how many years you can pay in, you can go to the government website, just Google it, put in state pension, and you can essentially see how many years you've been putting in. So pension is super important, but many people see pension either too complicated or really boring, or just don't know about it. So this is why I started this channel. This is why I'm here. This is why I'm giving you this information. And it's super important to understand that. And that's number 2. And don't brush off a pension. When I got made redundant I was working for a company for over 10 years, and I checked how much my pension contribution had been. How much was that in that pot? I'd been maxing out. I knew about this, the tax relief. So I was maxing out as much as I could into my pension because I knew it was a really good benefit. And I checked, I had £300,000 in my pension pot. And I was like, wow, I had no idea that I had so much of the, I was not doing anything special. I wasn't timing the market. I wasn't picking individual stocks. I wasn't doing anything intelligent. I was just, every month I was putting into my pension. And yeah, I think it was like I got it valued like £297,000, which is amazing of a pension pot. So that's why it's so important to understand this information, understand what you're doing with your investing. So number 3, and the good news is that's automatic. You don't have to think about it. You have to do it. Just check with your HR department, and that pension will run automatically without even doing it. So number 3 is you need to have a savings account. So you've got basically a bank account, but you need a savings account for emergencies. So you basically need to have an emergency, somewhere where you can keep an emergency fund. Hopefully you can see that. So number 3, my black pen's run out, but I've gone for a red pen. So hopefully you can still see that. So you need to have an emergency fund. And basically you want to automate it into an emergency fund. And before we get into the emergency fund, so you want to have this bank account, and you want to have all your bills coming out automatically from this bank account. So this might be your rent or your mortgage. This might be your bills, so your internet, your water, your gas, all coming out of your main account. You want to have enough of a cash flow coming in from your work into this bank, and then you basically pay from your main account. And then you have the emergency fund. So basically you want to make this as hard as possible to access, which may sound strange, but you don't want to start eating away at your emergency fund. And this is to cover any emergency. So for instance, if you're driving to work and your car breaks down, you don't want to have to pay that money on a credit card, for instance, because you're going to pay a lot of money on interest payments, basically. So you want to, if the boiler breaks down, if you own your place, the boiler breaks down, that you can cover that using your emergency funds. If you've got any other unexpected payments, this will come out of your emergency fund. And this is where you want to start to build up. You want to basically start building up a savings account. So I think of it like, don't think of it like saving, think of it like storing. So you're storing this money for later. So you might want to be thinking, actually, I want to go on a round the world trip. If you've saved that up over time, then you can use that from your savings account. If you want to start your own business, you can use, if you've got enough savings or enough money in storage, then this gives you options, this gives you choices, this gives you freedom because you can choose. Money gives you freedom because it gives you choices. So this is your emergency fund. Basically, you want to have about at least 1 month of expenses, 3 months expenses, up to 6 month expenses. And this all depends on how secure your employment is, how much your expenses, your monthly expenses are, and basically how what your risk tolerance is. If you've got a low risk tolerance, so if you're pretty safe, secure, and don't like to take risks, then you probably want to have a higher emergency fund than if you like to take more risks, then you might have a lower emergency funds, because most of that money might be going into the stock market, might be going into bonds, you might be buying property. So this is the third account, your emergency fund. And then the fourth account, you want to have an investment account. And as we said, it's never been simpler, easier, or cheaper to start investing. So another good rule of thumb is to use the Pareto principle, which is the 20-80 principle. So there was an Italian economist called Vilfredo Pareto, and he basically found out, he did this study, and he basically found out that these pea pods, so the pea, in the garden, these pea pods, he basically found out that 20% of the peas created 80% of 20% of the pea pods created 80% of the peas. And then he found out that everything in nature followed the same principle. I've got the book here somewhere. It was actually in this book. It's mind-blowing, actually, this book, The Mind and Society by Vilfredo Pareto. And it's a super thick book, but basically he came out with this theory, and it's stood the test of time. It's written in like 18th century or something, but it's mind-blowing. If you can understand the Pareto principle, the 20-80 principle, the 20-80 principle, then you're going to be way ahead of the pack of, you can apply this to your investing, you can apply this to your productivity, you can apply this to anything else in life. So it kind of blew my mind, this 80, it's called the 80, other people call it 80-20 principle, but I actually think it's a 20-80 principle. So 20% of your effort will create 80% of the gains. So that's number 4, your investing account. And you can use the Pareto principle for this investing account. So money coming in, 20% of that can go into your emergency fund. So 20%, and then that's going to be super impactful. And then remember to pay yourself first. So rather than getting to the end of the month thinking, I've got no money left. As soon as you get paid, 20% or at least 10% goes out into an emergency fund. And then you want to break the cycle of this, what I call the payday circle of life, where I meet people and they're living paycheck to paycheck. They get paid, go out, spend it, buy some nice shoes, go for some nice lunches, buy some gadgets that they don't necessarily need. And by the end of the month, the last few days, they're scrimping and saving because they've got no money left. And then they check their account. They're like, no, I don't have any money left over at the end of the month to invest or save. That's because you need to start saving at the start of the month. And then the worst case can happen. Maybe you don't go out the last weekend of the month, or you don't buy these gadgets that last weeks of the month. But at the end of that month, when you get paid again, you know that 20% or 10% of that money has gone into a savings account, and then it's going to build up and build up over time. Someone told me this. I was watching this at a YouTube video. Someone told me this years ago, decades ago, and I did this. I did that. Press of a button, automate it. And then I look back now, if I hadn't done that, I would have just been spending paycheck to paycheck, and I wouldn't have the investments that I have today. You don't even have to do anything clever with it. You just need to start, and it's more important to focus on your savings rate than trying to beat the market. That's what many people I see trying to do. When I think people think about investing, they look at these films like Wolf on Wall Street, or the Wall Street with Michael Douglas, or there's another film with Kevin Spacey called Margin Call about this. It's based on trading. I used to be a trader, and it was very similar to that. Wolf on Wall Street is very much trading, whereas what we're talking about here, number 4, is investing. It's two different games. You're playing a different game. The aim of the game of investing is to basically store up money into an investment account over time. So the title of my book, Millennial Money Mindset, if you want the fruits, you need the roots. It's about being patient. It's about building up that investment account over time, and you're building it up. And it's more important to focus on your savings rate, that 20% that we talked about, than trying to pick these individual stocks. So let's go back to this number 4. So you want to be investing into an ISA. So what is an ISA? So it's an individual savings account. And this means that if you're in the UK, you can put your money into a savings account, and this can be tax-free. So you won't be paying capital gains tax. You won't be paying dividend tax. And when you take this money out, you won't be paying income tax. You pay income tax on the way in, just like a regular, you'll be paid regularly with your pay as you go, PAYE, I think it is in the UK. But you won't be paying capital gains tax, or you won't be paying dividend tax. So a dividend is simply part of the profits you get as you owner of that business. So you won't be paying that. And this means that all this taxes won't be eroding your wealth, and it means that your money's going to go much further than it would be otherwise. And these are all perfectly legal schemes. The UK government want you to put your money into these schemes, these tax wrappers, or these tax efficient boxes, because it means that you're not going to be reliant on the state. So that's number 4, is you want to be putting in your money once you have enough of an emergency fund. Once you cover yourself for 1 or 2 months, even if you lose your job, for instance, you have enough of an emergency fund to cover yourself, so even the worst things can happen, and you'll be all right. And this is a massive peace of mind. This gives you so much peace of mind. And people are stressed and worried about money today, and that's because they know that they're living paycheck to paycheck. If they get made redundant, if they lose their job, if for whatever reason they can't work, they're going to be in real trouble compared to people who have an emergency fund. So yeah, into an ISA. So some really important points to mention about this ISA. So you want to check if it's covered by the FSCS, which is the Financial Services Compensation Scheme, which basically means that your money is covered up to £85,000. So for instance, if you put your money into an investment platform and that investment platform goes bust, the UK government will pay you up to the amount of £85,000 to cover you. which is great news. So you can put your money into that investment account, and you know that's going to be covered for if that investment platform goes bust, up to £85,000. And the second real important point to mention is you want to make sure these investment platforms are covered by the FCA. It used to be called the FCA. The FCA. So the Financial Conduct Authority. And this basically means that anyone starting an investment platform, anyone starting a bank, they have to go to the FCA, which is the UK regulation. They're based in the UK, and it's regulated. Basically, you have to regulate, make sure everything's regulated, and money is very heavily regulated. Anything with investments is heavily regulated, and this is to protect you, the consumer, when you put your money in. So you want to make sure they're covered by the FCA. And that means that they've given the green light for that. So that's a good investment platform to put your money in. So that's the second point. And then you want to make sure that this is going to protect you from scams. So financial scams have increased massively over the last few years. So it's I think there was, I don't know the exact total, but it was like something like £1.2 billion was lost in 2022 from financial scams. This is where people say, put your money into this this platform. Maybe you see it online, maybe it's on Instagram, maybe on LinkedIn. You put your money into your hard-earned money into this account from this person, then they run off with your money. Or it's not a regulated scheme, it's a Ponzi scheme where you put your money in and then they lose it all and you lose that money. So make sure it's covered by the FCA and make sure it's covered by FSCS. So your work might be saying, how do I know if these platforms are covered by the FCA, FSCS? Well, the great news is I've created a menu of platforms. We've reviewed and checked, and I've used most of these platforms myself, and we've got a menu of the best investment platforms out there. So and we rate them, we tell them what's good, what's bad. And if you want that, just write in the comments, yes, please give me the menu, just say yes, and I will send that over to you. Give me your details of where you want that being sent. And this is only available in the members area at the moment. So this is going to be available for a limited time. And just to highlight, this is usually only available for our members. You can pay a monthly members fee, and there's a wealth of information on our moneytips.org members area. So you can go in there, there's courses, there's resources, and there's every month we meet up at the last Monday of the month. And we network, there's people in the like-minded people like yourself, and we give you expert financial guidance, coaching, and basically give you the help and support you need, the accountability to make sure that money is going into your pocket, you're saving time in your day, and you're creating happiness for your life. So just put a yes in the comments if you want us to get that menu of the best FCA regulated platforms, investing platforms. And the great news is it's never been simpler, easier, or cheaper to invest. So there's so many great platforms out there, so many really good platforms out there doing great things. There's also really bad platforms out there. So if you choose if there's two similar platforms, you can pick one platform, and then over your investing lifetime, that's going to cost you tens of thousands of pounds more than a similar platform. I used to be a financial advisor, and one of the reasons why I left being a financial advisor is because I can only sell, or I could only use their one product, and their one product was pretty rubbish, to be honest. It was super high, expensive, and it basically just tracked the FTSE 100, which is the 100 biggest shares in the UK. So people were paying tens of thousands of pounds over their investment lifetime, compared to something which would cost hundreds, if not a few £1,000s, compared to tens, if not hundreds of thousands of pounds. So beware out there. And my job as a money coach, my job as the podcast host, YouTube channel, Millennial Money Mindset, and author of the book Millennial Money Mindset, we're impartial. We don't get any money from these investment platforms. We don't get any any reason why. There's no why prefer one over the other. We simply rate it on the best service that will give to you, the viewer, you, the consumer, or you, the investor. So that's number 4, and we've got the last one is number 5. So before we go to number 5, let's review. So let's think of it like a system. So basically you want to have your money. This is your money account. These are the 5 money accounts you need to create wealth in your life. So first of all, you need to have a job. So first of all, get some work, get some employment. Money will start going into your account. So have a real basic bank account. Go high street bank account, something that if anything goes wrong, you can pop into the bank, the high street bank, and get it sorted. You don't want to kind of be messing around with that. There's loads of great switching accounts. People may pay hundreds, if not thousands, no, maybe not £1,000, but yeah, hundreds of pounds to switch your account over to this. They offer very similar services. And another thing, what I'll do, I'll make a list of the best switching services and I'll put it into the members area as well. So yeah, this is another benefit of getting the members area. So from a few pounds a month, you can get hundreds of pounds by switching your bank account, by doing, it takes a few minutes. So number 1, have a bank account, and then make sure all your bills are going automatically out of that bank account, so you don't think or worry about it. You don't want to be going manually paying into for your rent or for your mortgage. Automate this. Check any subscriptions you're not using anymore. So maybe you have a gym membership and you haven't used for ages. Maybe I was paying into it was a basic insurance. I had I was covered twice basically, so I didn't need that anymore. So you can reduce that. Make sure you're insured as well. Or I had certain subscription service that you don't use anymore. This is maybe Netflix or Amazon Prime. If you're not using it, then get rid of it. If you're enjoying Netflix, then by all means keep using it. But yeah, just check what you're paying out for, because these are small things. Small gains can add up massively over time. So number 1, bank account. Number 2 is your pension. This is great news, because also this is going to be automated. You don't really need to think about it, but it's definitely worth checking. Go to your HR department, go to the government website, see how much you're contributing from your national insurance number, because at the end, when you're 67 and you go to claim your pension, you're going to be getting £7,000 a year just by contributing to a few pounds a month for your national insurance. And it might sound a far off time now, but in the long term, it's gonna make work. It's gonna be worthwhile paying into that national insurance, because you're going to get that back. £7,000 might not sound a lot, but if you're also putting into investment accounts and you're saving over time, you're putting into your pension, this is going to build up massively. It's going to give you peace of mind. It's going to give you time freedom. You're not going to have to pick up a second job, because you're going to be financially independent. So number 3 is have an emergency fund. So you want to have another savings account. And the great news about this also is that interest rates has gone up. So you can put this money in and you can get some interest back on that savings, which didn't happen a decade previously. So you have to check the interest rates now. As I said, I'll put a list in the members area of the best savings accounts that are at the moment, so you can pick that up. And yeah, make sure that there's enough in there to cover you for any emergencies. 1 month, up to 3 months. Even I know some people have a year worth of expenses in their emergency fund. You have to balance it up. It's up to you to work out your risk tolerance and how secure your income is. So number 4 is have an investment account. There's so many great investment platforms out there today. It's never been simpler. Automate this as well. So take money out of I take it out from my emergency fund into your investment account. Do that every month. Do it as soon as you get paid. Pay yourself first. Make sure, pick your risk tolerance, and that's all you need to do. Automate that. The thing is, it's so easy to do it, but then again, it's so easy not to do it. I meet so many people who come along to my monthly meetups and they're in the same position as they were a year ago. They said, yeah, I didn't get around to automating. I didn't get around to starting that investment. I didn't get around to saving that emergency fund. It's just a click of a button. Once you do it, it's all done. It'll be a massive piece of weight off your mind. So imagine that feeling you get when you hand in your last dissertation at university, or that feeling when you walk out the gates, when you went to school and it was summer holidays, or that time when you're off on holiday from from work, that great, get that finished feeling, where the same is when you've invested into and you automate that every month. Just your contributions, your monthly contributions are going to be much more important than picking those individual stocks. So coming back to those individual stocks, number 5 of the money accounts is a trading account. And so many people I see, I had it this week as well. We had a money meetup this Monday, and we just had a discussion with networking and chat, and we're saying what's been going well, what's been going bad. People jump from a bank account straight to the trading account because they see it on TV, they see it on the films, that they think you're going to have to pick the individual stocks and trying to make your millions on picking Bitcoin over something else. So this is the biggest mistake I see people making, getting confused between investing and speculating. So investing and trading. So investing is time in the market. You're just simply building up that capital over time, and that capital is going to, the aim is of the game is to build up that capital so you have enough assets that are going to pay you an income to cover your expenses. That's investing. Investing is simple, but it's not easy. And then on the other side, you've got trading. Trading is trying to pick individual stocks. You're trying to time the market. You're trying to buy and sell. And it's a completely different skill. It's a completely different mindset to investing. There's no right or wrong, but keeping those pots separate, to have an investing account and have a trading account. So automate your investing account. You can automate your trading account, sorry. But this is more your play account. This is kind of where you're mucking about. You're trying to beat the market, and don't get too stressed out about it. If you're doing the simple things, if you get brilliant at the basics, you've got money coming in, you're paying your pension, you've got money coming into your emergency account, your emergency fund, you've got your investment account basically automated, then don't stress out if you're not getting the results you want trading. Trading is a different skill. And I've got videos on trading, how to trade. I used to trade for Shell Trading. I made millions of pounds on the market, and it's very different. I had 8 screens around me, working 12-hour days, kind of wondering what I was doing with myself. And essentially, it's a very different strategy than investing. And investing is simple, but it's not easy. But trading is a different skill set. You're trying to time the market. You need things like a stop loss, which means if the market falls at a certain point, it will automatically sell out, so you're not losing a huge amount of capital. You can have stop gains as well. So that means that you can set a level where a price will hit and it will automatically sell, and you can take those profits and walk away from the table. It's more linked to gambling. So there's a high, the rate of success is much lower trading. The rate of success in investing is really high, actually. If you do the simple things, if you're brilliant at the basics, you're automating, you can track the 100 biggest shares in the UK, the FTSE 100. You could track the S&P 500, which is the 500 biggest shares in the USA. Or you can buy a global account and you're tracking thousands of companies all around. You own those companies all around the world. If someone buys a McDonald's, if they're eating that burger and you own McDonald's shares, part of those profits will go back into your pocket as a business owner, as a share owner. And that's investing. Whereas trading, you're trying to time the market, and it's very different. It's very much like Wolf on Wall Street, or Wall Street with Michael Douglas, if you've ever seen those films, or Margin Call with Kevin Spacey. That's very much trading, and it's good to keep those clear. And there's really good platforms out there today. There's really bad platforms out there as well. Remember, these platforms, although they're very good, they're not a charity. They're not there to they're there to make money. Ultimately, most of these platforms are listed on the stock market. They're there to make money for their shareholders as well. So they're not your friend. You have to understand that. So some of these accounts are really good, some of these accounts are really bad. So again, they're listed on the members area. If you want to go into the members area, what I'm doing, I've got 30 days free. You can go into the members area and see if you like it, see if there's value in there, and then you don't even have to pay until 30 days. Guaranteed. And then you can go in there and see there's so much value in there, and that monthly payment is going to save you so much more money than picking the wrong trading account or picking the wrong investment account. If you pick the wrong investment account, because you're investing for so long, 20, 30 years, it's going to compound over time. These small fees will compound over time. And essentially you're going to save loads of money if you become a member. You have accountability, you'll have expert guidance and support as well. You're going to be surrounded by like-minded people. So that's another benefit for the members area. Just go to moneytips.org, money tips with 2 P's, because we give you tips about money, saving, spending. We give you tips on different investment platforms, and tips also stands for tax, investment, property, pension, saving. So it's 2ps.org. So check out our website. I'll also link it below. So that's it. So the only 5 investment accounts you need. So 1, your bank account; 2, your pension; 3, your emergency fund, where this is a savings account, high interest savings account. Number 4 is your investment account, where you're putting your ISA in. And then number 5, your trading account. This is your play account. And one final really good tip is, with your trading account, only risk 4% of your net worth. So if you're only risking 4% of your net worth, then you're keeping your risk much lower. If you're going all in on Bitcoin, everything you've got on Bitcoin, and Bitcoin tumbles, you're taking much more risk. Investing, trading, money management is all about understanding risk, and risk comes from not knowing what you're doing. So by being here, by learning, understanding and supporting this channel, by liking, subscribing and telling a friend, this is going to help you out massively over the long term. So it's having that long-term mentality rather than the short-term mentality. Study the most successful people in the world, study the best investment strategies, and it's all having a long-term mindset rather than trying to take quickly. You're basically, the biggest epiphany I've ever had about investing is you're giving your money to invest in businesses over the long term rather than trying to take from the market. You're giving to the market. If you can get that mindset shift, then you're going to be on the front foot. You're going to be winning compared to everyone else. I share so many more tips, tricks, and guidance in my book, Millennial Money Mindset. It was shortlisted for the Financial Times Writing Prize, and it was an Amazon bestseller. It's packed full of guidance, packed full of, I think it's the best investment book out there. I haven't met another, and I've read loads, another guide. Basically, I combine all the best investment tips, tricks, and everything I've learned from, I was a financial advisor for St. James's Place, I was a trader for Shell, and I've done this myself. I have my own personal portfolio, and whatever I do myself, I give to you as well. So my name is Neil Doig. I'm the founder of Money Tips. Thanks so much for joining me. Please like, please subscribe, and please tell a friend about this channel, Millennial Money Mindset, my book, Millennial Money Mindset, and my website is moneytips.org. So thank you so much. And yeah, if you want that, the matrix of the costs complexity matrix, or the menu of the best investment platforms, then just write in the comment yes, and I can send that over to you once you give me where you want me to send that. Thanks so much, and be in touch. Take care.